Dave Spano, Derek Felsker, both on the road. So my name is Danny Clayton. It's not the B team. It's the B plus team. How's that? Deanne Phillips is Director of Client Learning Development at CFP and a CDFA. Welcome.
Thank you for having me.
If I somehow offended you, I don't think so. You and I go back. And Todd Voit is our Chief Investment Strategist, Annex Wealth Management. Good morning to you.
Good morning.
Nice to have you here. This is our Week in Review segment. It's always good because we take a look back. Deanne?
Yeah, so we usually start the week and we take a look at what happened over the week and what the implications are going forward, because that's really the important thing. And this week we happen to have some economic reportings that reflected some interesting numbers that I'd like to touch upon, Todd. One such was the ISM Services Index. This is really important in light of last year with, of course, the virus shutting down the economy. And share what happened with the ISM.
Well, that is an interesting index. It comes after the manufacturing index. But the epicenter of the pandemic and the crisis that followed was over services. So normally the services sector in a recession is resilient, but this happened to be a different type of event that caused the recession. It was a health crisis, and it really shut down the economy and hurt the services sector. So it's nice to see that bounce back in services. And then along with that is the services sector has in retail, restaurants, hospitality, et cetera, lower wage scales, and that's bouncing back as well. So that's a good indication.
So those were really good to see, and they created a strong market for the week.
Oh, yeah. Well, it's kind of a mixed market. The Russell's finishing down a bit, and then the S&P and Dow are up a bit. So other than that, it was kind of a quiet market. The numbers that are fueling the market's buoyancy, let's put it that way, are these better than expected economic numbers.
Yeah, so that's a great point, Todd. So we really have to we have to separate the market from the economy with the forecasts. They're really separate in how they think ahead.
Yep, two separate forecasts, and you can have great rosy forecasts on the economy, and then you look the valuation on the market to see if it's reflected in the market. And sometimes it is and sometimes it's not. Currently it is. So you might say, well, the market's expensive. Yeah, but the economy is very robust and looking great and everything's perfect. Well, it looked that way back in January of last year, too. You've got a market at the valuation levels that it's at, means it can be sensitive to bad news. It can kind of tell you how much more upside you have in the market, et cetera.
It is, but this is when we start to hear some of those financial terms come in like TINA. There is no alternative. And FOMO, fear of missing out, right? The momentum that we've been seeing in the market this year is pretty strong.
Oh, absolutely. So speaking of TINA, there is going to be an alternative if interest rates keep rising. And that's the challenge for the market. That
is a big challenge. Let's discuss this. Let's pivot to this. This is something as a wealth advisor that I'm asked about all the time, and that is inflation. So, of course, supply side issues. I'm hearing all the time about the cost and expenses of building, of lumber, for example. I had discussion with a client the other day. He couldn't believe cedar plank going from $6 norm to like $24 a plank. Right. And of course, the demand is definitely there. So let's talk about inflation for a moment.
Well, to that first point, the supply side, you've got bottlenecks galore out there across the whole entire industrial complex that's wreaking havoc. That is a short-term cause of concern for inflation. The demand side, what's unique about that is to have both of them in play at the same time. You go through periods, the mid-70s, that's supply side, 60s, 90s are demand side, pull inflation, and then you have both of them occurring at the same time. The problem is, while the economic growth aspect of it is great, when inflation gets a little too out of hand, and it's one of those, be careful what you wish for, because once it takes hold, and the Fed has certainly made it clear that that's what their intention is to be reactive versus proactive. Once inflation takes hold, it creates problems for the bond market, it creates problems for the equity markets, and it creates problems for people's portfolios.